Welcome back to Deep Macro Lens, where we explore the powerful underlying currents shaping the global economy, geopolitical dynamics, and their impact on personal finance. I am Ryan Oliver, and I have spent over 2 decades deeply researching economic cycles and financial markets. Over the past 2 years, news of workforce reductions from leading tech corporations like Google, Meta, Microsoft, and Amazon has been consistently reported. This is not merely an isolated event. It raises a fundamental question for many workers in the United States. Is my job position being affected by the rapid advancement of artificial intelligence, AI? Mainstream media often tends to oversimplify the issue, pointing to a weakening labor market or placing all blame squarely on AI. However, here at Deep Macro Lens, we understand that this picture is far more complex. These layoffs are not just immediate reactions, but rather the result of the interplay between macroeconomic factors and the ongoing technological revolution. In this episode, we will deeply analyze the data, present objective arguments, and provide the most comprehensive understanding so you can confidently navigate this changing landscape. To gain an objective perspective on the current layoff situation, we need to rely on specific data and place it within the broader economic context. According to aggregations from reliable sources like Layoffs and reports from Challenger, Gray, and Christmas, from the beginning of 2024 through the end of the second quarter of 2025, the global tech industry has seen over 215,000 job cuts, with a significant portion concentrated in the United States. This figure continues the trend from 2023, when the industry eliminated approximately 263,000 positions. This represents a substantial volume of personnel. However, assessing its impact requires detailed analysis. Despite these workforce reductions in the tech industry, the overall labor market in the United States continues to maintain stability and strength. Unemployment rate remains low and stable. As you can clearly see on the U.S. unemployment rate chart, black line, the overall labor market has maintained remarkable stability. The national unemployment rate in May 2025 was 4.2%. This figure has remained within a narrow range of 4.0 to 4.2% since May 2024, indicating the labor market's resilience. If you look at the chart, you will clearly see that this 4.2% is significantly lower than historical averages and especially lower than recessionary peaks, such as the 2008 to 2009 financial crisis, when the unemployment rate surged to nearly 10%, or the 2020 pandemic shock, which pushed it close to 15%. This suggests that highly skilled individuals affected by these tech layoffs are often able to find new employment relatively quickly in other sectors or at smaller tech companies. Initial unemployment claims remain low. This is a highly sensitive indicator of new layoffs across the entire economy. Weekly initial unemployment claims in mid-June 2025 hovered around 230,000 claims. This level remains below the 250,000 to 270,000 claim threshold, often considered a sign of a weakening labor market. This confirms that, beyond the restructuring waves in big tech, other sectors continue to maintain job stability. Overall labor market continues to create jobs robustly. Data from the Bureau of Labor Statistics, and as you can clearly see on the chart, total non-farm payrolls continue to show strong growth and have reached new peaks. In the last 6 months leading up to May 2025, the U.S. economy has created an average of over 180,000 new jobs per month. The total non-farm employment figure has now reached nearly 160 million employees, demonstrating the market's strong absorptive capacity, easily offsetting and even surpassing job cuts in specific sectors like tech. Another data point often discussed is the number of job openings. The number of job openings has decreased from its peak. According to BLS, job openings peaked at nearly 12 million in early 2022. And by April 2025, this figure had adjusted down to approximately 7.4 million. This decline might cause concern if viewed superficially. The period of 2021 to 2022 saw job openings surge to unprecedented levels, often with more than 2 job openings for every unemployed person. That was a historical anomaly. reflecting the Great Resignation and intense competition for labor. The 7.4 million job openings in April 2025, while lower than the peak, is still significantly higher than the pre-pandemic average of under 7 million, specifically during 2018 to 2019. This indicates the market is returning to a more balanced and sustainable state. Another frequently discussed data point is the relationship between the number of unemployed individuals and job openings, which is shown on the chart by this indicator. According to the chart, in April 2025, this ratio was approximately 0.83. This means there are about 0.83 unemployed people for every job opening. In other words, if we invert this ratio to calculate the number of job openings per unemployed person, it is approximately 1.2 times, 1 divided by 0.83. This still indicates more job openings than unemployed people, a sign that the market remains favorable for job seekers. If you look at the chart, you will see that during the extremely tight labor market in 2022, this ratio dropped to a record low of nearly 0.5 times, meaning nearly 2 job openings for every unemployed person. Conversely, during severe economic downturns like the 2008 to 2009 crisis or the start of the 2020 pandemic, this ratio surged very high, indicating many unemployed individuals but very few job openings. The current level of 0.83, while higher than the record low of 2022, still indicates a labor market that is in good balance and offers many opportunities. A measure of worker confidence in the market also adjusted from a record high of 3% in 2022 to approximately 2% in April 2025. Although it has declined, this figure remains higher than the pre-pandemic average, indicating that workers still feel confident enough to seek new opportunities, even if not quitting en masse as before. The development of AI and automation technologies, which we will delve into later, is helping businesses operate more efficiently. When a company can do more with fewer employees, or needs to hire fewer new ones, the number of job openings naturally decreases. This is a sign of increased labor productivity, rather than necessarily economic weakness. In a volatile macroeconomic environment with high capital costs, businesses are becoming more cautious about expanding their workforce. They prioritize optimizing existing talent and only hiring for critical positions, rather than hiring aggressively as during periods of cheap money. To truly understand the underlying causes of these layoffs, we need to examine 3 key forces interacting: the evolution of AI, monetary policy, and the global geopolitical landscape. Tech corporations are investing heavily in AI. According to IDC's forecast, global spending on AI and machine learning is projected to reach nearly $500 billion by the year 2027, a significant increase from approximately $200 billion in 2023. This investment requires companies to reallocate resources, leading to cuts in departments that are no longer strategic priorities. AI is helping to automate repetitive tasks, thereby increasing efficiency and reducing the need for labor in those specific roles. Positions in customer service, basic data analysis, and simple project management are gradually being handled by AI. A 2024 report by Goldman Sachs estimates AI could automate up to 300 million full-time jobs globally. This does not mean all jobs will disappear, but rather that they will be transformed or replaced by new roles requiring different skills. Companies are shifting their hiring focus. They need individuals with skills in AI, machine learning, data science, and effective interaction with AI. This leads to the replacement of traditional roles with AI specialists. With higher interest rates from the Fed, the cost of borrowing for companies has increased significantly. Venture capital investment activity in U.S. tech startups during the first quarter of 2025 remains significantly lower than the peak period of 2021 to 2022. According to PitchBook data, this forces businesses to focus more on profitability rather than merely expanding at any cost. In a high interest rate environment, the future value of tech companies is discounted more heavily. This compels companies to demonstrate immediate financial efficiency, leading to cost-cutting decisions. This intense rivalry, especially in semiconductors and AI, is driving companies to partly deglobalize their operations. Shifting production or research back to the United States incurs significant costs and requires workforce restructuring. Geopolitical tensions and global events continue to cause supply chain disruptions. This pushes companies to optimize resources and cut inefficient departments to enhance resilience. So, as these three forces interact, how will the U.S. labor market change in the age of AI? This is not about jobs disappearing, but a fundamental restructuring. 1. Core skills will be reshaped. Repetitive, easily automatable tasks will become less valuable. A 2024 report by the World Economic Forum projects that, by the year 2027, approximately 44% of the core skills workers need to perform their jobs will change. Conversely, human-centric skills that AI struggles to replicate, such as critical thinking, genuine creativity, emotional intelligence, complex communication, leadership, and especially solving complex problems requiring ethics and judgment, will become extremely important. 2. Increased labor and income disparity. Those with skills in AI, data, or the ability to quickly adapt to new technologies will have an advantage. According to a 2024 report by McKinsey, roles requiring advanced AI-related skills could see wage growth of up to 20 to 30% in the next decade, while less skilled positions may face downward wage pressure or job displacement risks. This could lead to significant stratification in the U.S. labor market. 3. Pressure on education and training systems. Educational institutions need to rapidly update curricula to meet new market demands. Without significant investment in retraining and upskilling the current workforce, the United States could face critical skill shortages in emerging fields and a surplus of workers in traditional sectors. 4. Geographic shift of employment centers. Traditional tech hubs may no longer be the sole creators of high-tech jobs. Regions focusing on applying AI in agriculture, healthcare, manufacturing, or other service industries could flourish, creating new tech centers. In summary, the wave of layoffs in the tech industry is not a sign of collapse, but a critical transformation phase, driven by AI, monetary policy, and geopolitical competition. Your job is not necessarily insecure, but it is evolving and demands proactive adaptation. With over 2 decades of analysis, I have some strategic advice for every worker in the United States to not just adapt, but to thrive in this era. First, proactively embrace learning and working with AI. Do not view AI as a threat. Instead, learn how to use AI tools in your work, regardless of your industry. Online courses from Coursera, EDX, or specialized programs from Google AI, Microsoft Learn are valuable resources. Understanding and collaborating with AI will be a significant advantage. Second, focus on developing human-centric skills that AI struggles to replicate. These include deep critical thinking, genuine creativity, emotional intelligence, communication and negotiation skills, as well as managing people and solving complex problems requiring ethical judgment. These factors constitute your unique value. Third, build your professional network and develop your personal brand. In an ever-changing labor market, a strong LinkedIn profile, participation in professional communities, and maintaining quality relationships will help you seize new opportunities quickly. Fourth, ensure your personal financial health. A sufficient emergency fund, from 6 to 12 months of living expenses, is crucial to navigate any career transition period. Additionally, consider diversifying your income streams if possible, to reduce complete reliance on a single job. The world is changing rapidly, but with proper preparation, a sharp perspective, and continuous adaptability, you can confidently position yourself to not only overcome challenges but also thrive in the age of AI. Always follow Deep Macro Lens for in-depth and timely analysis. Knowledge is the ultimate key to self-reliance in this world. Thank you for listening. See you in the next episode.